I want to start with a scenario that, I think a lot of us have been in.
Okay.
You're sitting in a quarterly business review. You've got your coffee. You're feeling pretty good about how your department's
You
doing.
hit your milestones, yeah.
Exactly. Then the CFO walks in. The lights dim, a spreadsheet goes up, and it is just a wall of numbers.
The dreaded eye chart.
Yes. And the whole room just shifts. Suddenly you're hearing words like EBITDA, accruals, working capital.
And you just find yourself nodding along.
Just nodding, hoping nobody asks you a direct question because, honestly, you have no idea what story those numbers are actually telling.
It's like the universal professional anxiety dream. You're an expert in your field, but the second the conversation turns to finance, you feel like you've lost your seat at the table.
So that is exactly what we are tackling today. We're doing a deep dive into financial intelligence, a manager's guide to knowing what the numbers really mean.
Great book.
It's by Karen Berman and Joe Knight. And it's been around for a while, but it is still like the gold standard for non-financial managers.
The promise is pretty bold, too. It says you can stop being just a spectator in your own company.
And the context for this book is so important. It came out in 2006.
Right after all those huge corporate scandals.
Exactly. We're talking the blast radius of Enron and WorldCom. Those things happened, in part because financial literacy was treated like this secret code that only the finance guys could understand.
A dark art.
A dark art, yeah. And Berman and Knight basically said, let's democratize this. Their whole argument is if the people on the field don't understand the scoreboard, they can't help the team win.
But there's this huge mental hurdle to get over first. I think most of us see finance as a hard science. It's like physics. $100 is $100. It's objective.
Right. 2 + 2 is 4.
But the authors open with this idea that just completely undermines that. They say finance is an art. And that is the premise that usually stops people in their tracks. We want it to be math. But Berman and Knight say, no, finance is actually the art of using limited data to make a best guess about reality.
Best guess is not a phrase I find comforting when we're talking about my company's financial health.
It sounds scary, doesn't it? But they're not talking about, fraud or cooking the books. They're talking about the mechanics of something called accrual accounting.
Okay, that's one of those words that makes people's eyes glaze over. So let's break that down. What does accrual mean in practice?
Well, most of us run our own lives on a cash basis. If there's money in your bank account, you feel rich. If there isn't, you're broke.
Simple enough.
But companies use an accrual basis. The goal is to match your revenue with the expenses that you use to generate that revenue, no matter when the actual cash moves.
Okay, in theory, that sounds logical. But where does the art or the guessing come in?
It comes in because you have to make assumptions to make those matches work. The book uses a great example. A lawsuit. Let's say your company is being sued. Your lawyers think there's a chance you'll lose, and if you do, it could cost $1 million. Now the accountant has to decide. Do we record that $1 million expense now? Or do we wait for the final verdict?
Is there a rule for that?
There are guidelines. They're called GAAP. But the guideline says you only record the expense if the loss is probable and estimable.
And I'm guessing probable is a fuzzy word.
Completely fuzzy. I mean, what is probable? Is it a 51% chance? 75%. That's a judgment call.
I see.
So a manager who wants to make the quarter look good might say, oh, it's not probable, and the expense stays off the books. Another manager might want to lower expectations, so they say it's very probable, and they take the hit now.
So the reality of the lawsuit didn't change at all, just the human interpretation of it.
That's it. So that net profit number at the bottom of the income statement, it's not a hard fact. It is basically an opinion built on a whole stack of these little estimates.
Depreciation must be another one of those.
Classic example. You buy a server for $100,000. Do you write that cost off over 3 years or 5 years?
That's a choice.
It's a choice. If you pick 5 years, your expense is lower each year, so your profit looks higher today. But the actual cash that left the bank is exactly the same.
Wow. So that's a huge paradigm shift. It means when I'm looking at a financial report, I shouldn't just be reading it. I should be asking, what assumptions did we make to get here?
Precisely. You shift from being a passive consumer of the data to an active interrogator of it. The spreadsheet isn't the truth. It's a model of the truth.
Okay, so once we accept that subjectivity, we need to understand the framework. The book breaks down the big 3 financial statements. The first one, I think most people know, is the income statement.
Right. The P&L, profit and loss. Revenue minus expenses equals profit. Think of it like a movie. It tells a story over a period of time, like a full year.
Then you have the balance sheet. This is the one I feel like non-finance managers totally ignore.
They really do. They only care about the P&L because that's where their bonus is usually tied.
Right.
But they ignore it at their peril. If the P&L is a movie, the balance sheet is a photograph. It's a snapshot at one specific moment in time. It shows what you own your assets and what you owe your liabilities.
So why should I, as a marketing manager, care about the balance sheet?
Because the balance sheet tells you if the company is healthy enough to survive a storm. You can have a great P&L, lots of sales on paper, but if your balance sheet shows you're drowning in debt, that profit is irrelevant.
You're driving a fast car with no gas in the tank.
Exactly. And that brings us to the third statement, which the authors clearly think is the most important one, the cash flow statement.
This is where the truth comes out.
This is where the rubber meets the road. And it leads to, I think, the single biggest aha moment in the entire book.
Which is?
Profit is not the same as cash.
This is the one that trips up so many smart people. It just feels counterintuitive. Yeah. I mean, if my company's profitable, doesn't that mean we have money?
You would think so, but no. A company can be wildly profitable and go bankrupt at the same time. It happens all the time, especially when a company is growing fast.
How does that actually work?
Okay, let's use an example.
Right.
Imagine you run a company that makes high-end furniture. You get a massive $1 million order from a hotel chain.
Sounds like a great day. Time to pop the champagne.
On the P&L, yes. You record that $1 million in revenue the moment you ship the furniture. Your profit for the month looks amazing. But did the hotel pay you in cash right then and there?
No, probably not. They send an invoice that says net 60 or net 90 terms.
Exactly. So you won't see that cash for 2 or 3 months. But here's the trap. To build all that furniture, you had to buy the wood today. You had to pay your workers this week. You had to pay the electric bill this month.
So all my cash is flowing out the door to support this big sale.
While the revenue is still just a promise on a piece of paper. That's called the working capital trap. As you grow, you need more inventory, more staff, and that just eats up cash. If you grow too fast, you can literally run out of money before your customers pay you. You are profitable, but you are insolvent.
That explains so much. I've seen this happen where the sales team is celebrating a record quarter, but the CFO is running around freezing all the budgets.
That's it. The CFO is looking at the cash flow statement. They know cash is king. You can survive for a long time without a profit. I mean, look at Amazon in the early days. But you cannot survive one single day without cash to make payroll.
That distinction really changes how you'd argue for a project, doesn't it? It's not just this will drive sales, it's this will improve our cash cycle.
Now you're speaking the language. And really, that's what this book is all about. Finance is just a language. It's like French or Python. It has its own vocabulary. And once you learn it, it's not intimidating anymore.
Oh, let's tackle some of that vocabulary because the acronyms are intense. The big one you hear in every boardroom is EBITDA.
Yes. Earnings before interest, taxes, depreciation, and amortization.
It's a mouthful. And it always feels like a way to make the numbers look better than they really are. Is that fair?
It can definitely be used that way, but its legitimate purpose is for comparison. Let's say you're comparing 2 companies. One is a startup that borrowed a lot of money, so they have huge interest payments. The other is an older company with no debt.
Okay.
If you just look at net profit, the startup looks terrible. EBITDA strips away those financing decisions and tax differences so you can compare their core operations apples to apples. It's asking, is the basic business model actually working?
But, and I feel a but coming.
A huge but. The book warns that EBITDA is not cash flow. Warren Buffett famously hates it. He asked, does management think the tooth fairy pays for capital expenditures?
What does he mean by that?
Well, the D in EBITDA is depreciation. That's the wear and tear on your equipment. Eventually, you have to buy new machines, new servers. EBITDA pretends that cost doesn't exist.
So it's a useful tool. But if you treat it as the absolute truth, you'll find yourself with broken equipment and no money to replace it.
It's a tool, not the truth. Exactly.
Okay, let's talk about ratios. The book says they're like a doctor's vital signs for the business. What are the key vitals a manager should be checking?
The classics are often the most powerful. Gross margin percentage is a huge one.
So that's revenue minus the cost of goods sold.
Right. It basically tells you for every dollar of sales, how much is left over to run the rest of the company, marketing, R&D, all of that. If your gross margin is slipping, it tells a story.
What's the story?
Either your production costs are going up or, and this is more common, you're losing pricing power. You're having to discount your product to make sales. It's a direct measure of your product's strength in the market.
Okay, what's another critical one?
Going back to our cash conversation, DSO days sales outstanding.
Right.
It measures the average number of days it takes for you to get paid by a customer.
Give me a real-world example of how a manager, like a non-finance manager, impacts that.
Perfect. Imagine you're a sales manager. It's the end of the quarter, and you're desperate to hit your quota to get that bonus. A client says, I'll sign this big deal, but I can't pay for 90 days.
And because I want the win, I say, sure, no problem.
You say yes. You hit your revenue target, you get your bonus, everyone cheers. But you have just wrecked the company's DSO. You've pushed cash collection out by an extra 2 months. If your whole sales team does that, you could literally drive the company into a cash crunch.
That is a perfect example. The sales rep thinks they did a great job, but financially, they just created a huge risk for the entire organization.
And that gets to the whole strategic part of the book. Berman and Knight are huge advocates for transparency, for showing these numbers to everyone, not just keeping them in some finance ivory tower.
I've heard the argument against that, though.
Yeah,
The fear is if you show the engineers the P&L, they'll see the big revenue number and just say, hey, we're rich, where's my raise?
that's the common fear. But the authors would say that's a failure of education, not transparency. If an employee thinks revenue is the same as cash, that's because no one ever taught them the difference.
So the solution is to teach them the business of the business.
That's the phrase. Show them the revenue, sure, but also show them the expenses, the cost of goods, the cash flow constraints. Then they have context for the no.
It's not just a no, it's a no because our working capital is tied up. It turns employees into partners.
It turns them into owners. And that leads to maybe the most practical takeaway for anyone listening. If you want to start building this financial intelligence tomorrow, you just need to do the impact exercise.
Okay, walk us through it.
It's a mental simulation. Before
Yeah.
you make any decision, hiring a temp, buying inventory, anything, just quickly trace its path through the big 3 statements.
Let's try one. Say I'm an operations manager, and I decide to buy 6 months of inventory at once to get a 10% bulk discount.
Okay, trace it. On the P&L, your cost of goods will eventually go down. That looks good. Your profit margin improves.
Score 1 for me.
But on the balance sheet and the cash flow statement, you just took a massive chunk of cash and turned it into boxes that are going to sit on a shelf for 6 months. You've killed your company's liquidity.
So the question becomes, is that 10% discount worth the risk of tying up all that cash?
That's the question. And there isn't always one right answer. But financial intelligence is just realizing there is a trade-off. It stops you from only thinking about your own department's metrics.
It sounds like this is all about just asking better questions.
That is the ultimate goal. The book suggests a technique called spotting assumptions. When you get a report, don't just look at the bottom line. Pick one number, like bad debt allowance, and just ask the finance person, hey, can you walk me through how we calculated this estimate?
That probably changes the whole dynamic of the conversation.
Instantly. It signals that you're paying attention, that you're a strategic partner, not just someone waiting for the meeting to be over. You're speaking their language.
So if we boil this all down, what's the big transformation here? We're not trying to turn everyone into an accountant.
No, absolutely not. The goal is to be a better leader. I'd say it comes down to 3 things. First, finance is biased. It's built on estimates. Always ask about the assumptions.
Okay.
Second, cash is king. Never, ever confuse profit with actual money in the bank. And third, it's just the language. Learn the key terms, and the fear just evaporates.
I really like that idea of shifting from feeling intimidated to feeling curious. You don't need to be a math whiz. You just need to be curious about how the whole business machine actually works.
That is it. It's about learning to read the story the business is telling you. And once you can read the story, you can help write a better ending.
Well, I am definitely going to look at spreadsheets a little differently in my next meeting. I might even ask about the depreciation schedule.
Just be careful. You start asking those questions, they might put you on the finance committee.
That's a risk I am willing to take. This was fantastic. You made a really dense topic feel incredibly clear.
My pleasure. It was fun.
And for everyone listening, if you want to keep digging into ideas like this, learning broadly and getting better every day, check out Better Every Page on YouTube. We've got a lot more deep dives there.
And tomorrow, find one ratio in your business and just ask yourself, what story is this telling me?